Acquiring a business? BizNexus simplifies it. Access thousands of updated opportunities in our DIY marketplace or supercharge team sourcing with OmniSource, your all-in-one platform for on-market, off-market, and coming-soon deals. Scale smarter today. Learn more or book a demo at www.biznexus.com.
Disclaimer from the always present legal team. Podcast conversations don't necessarily reflect the views of BizNexus Incorporated. Everything you hear is informational news and updates from around the industry. We're not recommending any investments. We're not offering any investment advice. Be sure to do your own homework.
Welcome to The Deep Dive, your shortcut to being truly well-informed. Today, we're plunging into a world often viewed, as just rows of numbers and dense legal documents, mergers and acquisitions. But what if I told you that, especially in the middle market, this landscape is undergoing a really profound transformation? It's no longer just about the traditional financials anymore.
That's absolutely right. This deep dive is all about understanding the evolving role of technology in middle market M&A. And it really is foundational now. Think of it this way. Technology isn't just some separate department anymore. It's really the engine that drives a company's actual enterprise value, these digital capabilities. They're becoming the absolute key to commanding those premium valuations and also, frankly, to seriously accelerating how fast deals get done. Without this digital engine, companies are they're simply leaving significant value on the table.
And our insights today, they're drawn from a truly excellent source. It's the Chiron Financial Industry Focus article from June 2025. It offers a really comprehensive look at current market dynamics. It delves into core technology trends, highlights some crucial regional differences between the U.S. and the EU, and even gives us some pretty fascinating predictions for the future.
Yeah, it's an incredibly insightful piece, and we definitely want to acknowledge the expertise that went into it, particularly the authors, Candice Hubert, Johan Bosch Salcedo, and notably Michaela Siekman. She's an associate, and her contributions were really instrumental in bringing these crucial insights to light. It's great work.
Definitely. So our mission for you today is clear. We're going to unpack why technology isn't this siloed thing anymore in M&A. It's a foundational pillar. By the end of this deep dive, you should have a much clearer understanding of what buyers are truly looking for in today's middle market. Okay, let's start by unpacking a major shift highlighted in the article. The global M&A environment has, it's decisively moved from prioritizing deal volume to valuing deal value. This isn't just a subtle change, is it? It suggests a fundamental reevaluation by buyers. Fewer deals, maybe, but richer ones, especially as tech is involved.
Exactly. What's fascinating here is that buyers are becoming far more discerning, much more selective. They're narrowing their focus, opting for fewer but significantly more sophisticated transactions. The article gives clear examples. In the U.S., for instance, tech-driven M&A activity has seen a remarkable rebound in deal value. Now, the overall deal count might still be below, say, pre-2022 levels, but the value surge tells the story. This isn't just a market fluctuation, it's a strong signal that investors are prioritizing strategic alignment and deep digital integration over just, buying more companies. They're investing in the future capabilities of a business, not just its current state.
That focus on quality, it makes complete sense. But from an investor's perspective, how are they actually measuring that digital quality during due diligence? Are there less obvious things they look for? Hidden red flags?
Oh, absolutely. It's no longer just about, seeing a list of tech assets on a spreadsheet. Buyers are now looking much deeper. How integrated are these assets? How scalable? They want to see what the article calls digital scale, basically. Can this company rapidly expand its digital operations if needed? Is it built for growth? They're scrutinizing infrastructure readiness. Is the underlying tech backbone modern? Is it flexible? Is it ready for integration into the buyer's systems? Or is it going to be a massive headache? And perhaps most critically, resilience. Can the company's digital systems actually withstand market shocks, cyber threats, or just rapid changes in the business environment?
Right. Resilience seems key.
These aren't just buzzwords. They're concrete capabilities. They directly impact the success or failure of the acquisition post-close. And if we connect this to the bigger picture, while both the U.S. and the EU are undeniably leaning into technology as a core M&A factor, their specific deal landscapes, they differ in some important ways.
Okay, that's intriguing. Tell us more. What sets the U.S. scene apart when we're talking tech and M&A?
Well, U.S. firms generally benefit from more robust capital markets. There's just a broader base of private equity activity historically, and generally a faster pace of technology adoption. Culturally, maybe, they tend to move quickly.
Yeah.
You see U.S. middle market firms often being early adopters of things like AI and automation, and they frequently integrated cloud and analytics tools right into their core operating models, sometimes from the ground up. This gives them a significant advantage, in demonstrating agility and scalability to potential buyers.
So a more dynamic, maybe faster-moving environment in the U.S.
Okay.
But what about the EU? What are the specific challenges or unique strategic priorities for their firms?
It's a bit different. In contrast, the EU often exhibits a more fragmented capital access environment, though initiatives are trying to change that. However, they show really strong intent when it comes to consolidating key infrastructure sectors and investing heavily in digital transformation, often with a very keen eye on regulatory alignment. Think GDPR, things like that. EU firms tend to be perhaps a bit more deliberate in their approach compared to the US, but they are certainly investing heavily in strategic platforms and, crucially, cybersecurity modernization. This is driven by both operational needs and those increasingly stringent compliance demands. Data privacy and digital sovereignty are huge drivers in the EU.
Yeah, that makes sense. It's interesting how both regions clearly value technology, but they approach its integration and acquisition with different, maybe different strategic lenses, different priorities. And the article suggests that cross-border activity is actually expected to grow, especially as the Capital Markets Union progresses. That's the EU's big push for a single market for capital. That's bound to intertwine these tech considerations even more on a global scale, wouldn't you think?
Absolutely. It'll make understanding both environments even more critical for international players.
Okay, so now let's drill down into the specifics. The article identifies 4 core technology trends that are truly reshaping middle market M&A. Can you walk us through what these are and why they're so pivotal right now?
Yes, absolutely. And the article highlights how these trends aren't just isolated shifts. They really interweave, they reinforce each other to create this new M&A landscape. The first, and arguably the most transformative right now, is AI and predictive analytics. This isn't, futuristic anymore. It's functional. It's embedded in processes. Middle market deal makers are now, quite routinely actually, using machine learning and natural language processing for things like sourcing targets more effectively, for assessing risks with much greater precision than before, and even modeling potential synergies in something close to real time. This capability, it drastically shortens deal timelines, and it significantly strengthens the quality of decision-making. Think about generative AI's impact to rapidly reviewing mountains of legal documents, creating more sophisticated cash flow forecasts, or even just continuous market monitoring. It's a huge game changer for efficiency and accuracy.
Wow. So it's not just about crunching numbers faster, but really about smarter, quicker decisions at basically every stage of the deal.
Yeah.
And building on that intelligence.
Yeah.
What about making sure the underlying systems, the data, are actually secure? That seems paramount.
Precisely. You hit it exactly. And that brings us straight to the second critical trend, cybersecurity as a value lever. This has truly transitioned. It used to be seen as just an IT department concern, maybe a cost center. Now, it's a direct valuation factor, full stop. Buyers demand confidence. They need assurance that potential targets can withstand the evolving cyber threats out there, that they can protect sensitive data effectively, and importantly, recover quickly if something does happen. The article makes it crystal clear. A poor cybersecurity posture can lead to significant price reductions. Or, frankly, it can kill a deal entirely.
Yeah, I believe that.
Nobody wants to acquire a ticking time bomb of data risk, right?
Yeah.
Conversely, companies that can demonstrate strong governance, clean audit trails around their cybersecurity, they often gain substantial negotiating power. It's about de-risking the acquisition for the buyer.
And I can absolutely see why. I mean, cybersecurity isn't just about protecting data, it's protecting the entire future valuation of the company you're buying. Are there specific vulnerabilities that are proving to be real deal breakers in the current market? Things buyers hone in on?
Yeah, good question. Buyers are increasingly concerned about things like unpatched legacy systems, old tech that hasn't been updated, inadequate incident response plans. What do you do when you get hit? And a big one is a lack of clear data governance policies. If a company can't clearly demonstrate that it knows where its sensitive data is and how it protects it, that's a massive red flag. On the flip side, things like security certifications, evidence of regular penetration testing, and showing a mature security-aware culture, those are huge positives. Okay, so the third trend builds on this foundation. Cloud-first infrastructure and automation. Cloud-native platforms, properly integrated ERP systems, that's enterprise resource planning, kind of the central nervous system for a company's operations and real-time performance dashboards. These are no longer nice to have. They are now considered critical infrastructure for ambitious middle-market companies. These tools are absolutely essential because, one, they enable scalable operations. Two, they simplify the due diligence process dramatically, think clean data access. And crucially, three, they reduce integration risk post-close. A smoother transition is worth a lot. Plus, the automation of things like compliance checks, financial reporting, and performance tracking. That's viewed as a major advantage by investors and advisors. Streamlines everything, provides clear visibility.
Right, a true digital backbone then. Seems essential for both growth and just running efficiently day to day. This leads us to the final trend identified in the article, one that might surprise some folks with its direct impact on M&A value.
Indeed. It's maybe less obvious at first glance, but very powerful. The fourth trend is embedded finance and supply chain digitization. We're seeing how embedded financial tools, things like integrated B2B payment systems, lending APIs, those are application programming interfaces, basically software connections allowing different systems to talk and automate transactions, or sophisticated working capital platforms. These are allowing companies to actually expand their margins and significantly improve their relationships with vendors and customers. This is particularly important in sectors with complex supply chains or significant international exposure. Imagine, say, a manufacturing company. It's not just selling products anymore. Maybe it's offering financing options right at the point of sale through an embedded tool. Or it's optimizing payments seamlessly across its global supplier network using digital platforms. Firms that have made these kinds of investments, they tend to present stronger financials, greater operational resilience, and often more diversified revenue streams. And that is incredibly attractive to potential buyers.
Okay. So it's about more than just internal efficiency. It's actually using tech to create new value propositions, new revenue opportunities, and solidify those crucial business relationships through smart financial tech. Okay, putting it all together. What does this all mean for the future? The article provides some pretty clear predictions for, say, 2025 and beyond. What should we be bracing for?
Yeah, the forecasts are quite definitive, and they point in one clear direction. Technology will become even more tightly linked to both deal viability, whether a deal even happens, and the overall enterprise value achieved. Analysts cited in the article are forecasting that AI and automation tools will be integrated into over half of all mid-market M&A transactions by the end of 2025.
Wow, half. That's a huge integration level, really transforming how deals get done and maybe even what qualifies a company as a good target.
Exactly. So if you're looking to sell your company, or perhaps you're on the investment side, understanding and verifying these tech capabilities is rapidly moving from being a bonus to being an absolute prerequisite.
It's becoming fundamental.
Precisely. Companies that proactively adopt that scalable, secure, and automated infrastructure, they are expected to see faster exits and attract stronger, more committed investor interest. Furthermore, these digital capabilities, and here the article points especially to AI and cloud-based operations, they're projected to drive really impressive improvements, something like 20–30% in deal cycle speed and due diligence efficiency. This isn't just about small gains. It's about fundamentally changing the speed and the quality of transactions in the middle market. And something we touched on earlier, cyber readiness. What was maybe once a significant differentiator. It will very soon become just a baseline expectation, table stakes. It'll likely be non-negotiable for serious buyers moving forward.
That's a stark forecast, isn't it? What was once a competitive edge will soon just be the entry fee. So for the operators, the founders, the investors listening right now, what does all of this mean for them in really practical terms? What's the strategic guidance the article offers? How should they prepare?
Yeah, the article provides very clear, very actionable advice. It's not just theoretical. First, it says you need to rigorously assess your own digital maturity. Look across all critical functions: finance, compliance, IT. Understand where you truly stand today, not just where you think you are or where you want to be. Be honest. Second, you must actively identify and address any gaps, especially in your cybersecurity posture and your cloud readiness. And do this before you even think about entering a deal process. Don't wait for due diligence to expose weaknesses. Those can be incredibly costly revelations, both financially and reputationally.
Right. Be proactive in finding the weak spots and fixing them now.
Exactly. Third, prepare clean, ideally automated data flows specifically for diligence. Make it easy for the buyer to see what's going on. This speeds up the entire process immensely, and it builds crucial buyer confidence in your operational transparency. They trust what they can easily verify. And finally, and perhaps this is the most important mindset shift, You need to integrate technology seamlessly into your company's value narrative, your story. Don't just list your tech stack on a slide. Explain how your technology actively creates efficiency, how it builds resilience against risks, and how it directly drives growth and scalability. Show, don't just tell, how your digital infrastructure clearly supports long-term scalability and operational transparency, because at the end of the day, that's what sophisticated buyers are truly looking for today.
That's such a crucial point. Okay, as we bring this deep dive to a close, the central takeaway feels incredibly clear. Middle market M&A is undergoing a fundamental change. Maybe not in its overall pace all the time, but certainly in its priorities. Buyers are looking far beyond just the traditional metrics, strong margins, customer growth. Those still matter, of course, but they are now actively seeking proof of digital discipline, digital maturity. In both the US and the EU, technology has become an absolute prerequisite for achieving scalability, for ensuring seamless integration post-deal, and for effectively mitigating risk. It's no longer just an add-on, it's truly the foundation.
And this, I think, raises a really important, perhaps provocative question for all of us to consider as we look ahead. Given the rapid, relentless pace of technological advancement we're seeing, how might the actual definition of digital maturity itself evolve in just the next few years? What will good look like in 2028 or 2030? And what does that potential shift mean for the long-term M&A strategies you or your company might be considering right now?
That is a truly thought-provoking question to leave you with. Where's this heading next? Thank you for joining us on this deep dive into the evolving landscape of middle market M&A. We hope you feel much more informed and ready for what's next.
Thinking of exiting your business or taking on a private equity partner to help you grow faster? BizNexus has you covered. Tap into our network of thousands of best-fit investors, acquirers, and proven M&A advisors, and we'll help you begin the relationship confidentially on your terms, your timeline. Learn more at biznexus.com.